Hello and welcome to this special program. We are calling this the Global Reset under Trump 2.0. I'm Prashant Nair. The new U.S. administration under President Trump seems determined to upend the world order as we know it. From tariffs to security alliances, everything seems to be up for negotiation. How does one navigate this changing environment? That's the big question. I have with me someone who tracks all this very, very closely. Louis Gave is the founding partner and chief executive officer at Gavekel Research. Gavekel is a financial services company. They do research in global markets, global economics, based out of Hong Kong. Gavekel is widely followed for their institutional research, commentary on daily global macro events, and of course some of the bigger trends as well. I also have with me Manish Bhandari, who's director at Vallum Capital, a fund management business based right here in Mumbai. Gentlemen, great to have both of you here. Thank you very much, Louis and Manish.
Thank you. Thank you for hosting us.
Thank you so much for having me. Us.
This is an extremely interesting time. A lot of things, everything seems to be changing.
It sure is. Definitely keeping busy. Lots to think of, lots to write about, lots to stay in business for.
So let's start with what is most current, most recent, right? Tariffs, Louis. How real are these tariffs in terms of their durability?
Yep.
Because the Canada-Mexico tariffs and, of course, the 10% extra tariffs on China, they seem to be motivated by sort of essentially stopping the flow of illegal drugs into the US, right? It's not to raise revenues, at least that's not the stated objective. So is this going to off-ramp at some point, or you think this is here to stay? These tariffs particularly?
I think you put your finger on it. The big question is, are the tariffs a tool towards achieving something, or are they the end goal? I think so far, there's still a lot of signs that Trump is looking at tariffs like a tool to achieve something else. Now, fundamentally, what does Trump really want to achieve? I think the first goal right now, what seems pretty obvious, at least to me, is that contrary to Trump 1.0, who kept tweeting about the stock market making new highs, and what they're really worried most about is three things. They want to get the bond yield down, they want to get the US dollar down, and they want to get the oil price down. And pretty much every one of these policies that they've implemented, now there's other things, yes, they want to stop the drug flow, etc., but everything they're implementing is really driven by these three goals, and including the tariffs. For me, and I could be wrong on this because it's very hard to predict what Trump is going to do next, but for me, the tariffs remain a tool. And it's a tool that you're going to use to beat up America's trade partners, whether Japan, whether Korea, whether China, and to say, look, guys, I'm going to tariff you unless you go out and you buy US treasuries and unless you raise the value of your currency. I think the next few months we get a lot of this until basically Xi Jinping and Trump meet in May, and then we'll have a better outlook on whether tariffs are here to stay or whether some kind of Mar-a-Lago Accord, to use Scott Bessent's term, whether some kind of Mar-a-Lago Accord gets achieved.
Are the three things you mentioned consistent with a higher stock market?
I don't think it's as much of a priority, to be honest.
That's an interesting, important point, because, I mean, the general assumption is that he's very focused on the Dow being at a new high. It's like a point of pride. But you're saying actually the target this time is not higher stock markets, it's lower cost of borrowing.
I think so. You'll notice this time he hasn't tweeted once on the level of the stock market.
Okay.
You've had tweets from Elon Musk, you've had talks from J.D. Vance, from Scott Bessent, from Trump himself on the 10-year yield. And I think the reason for that is actually the setup today in the U.S. is completely different.
Yeah.
The big problem is in the second half of this year, you have a massive amount of debt to roll over. Because remember, in the second half of 2020, interest rates were at record lows. Every single U.S. corporate went out and issued debt. You know, when interest rates were below 2%, you're a CFO of a company, it'd be criminal not to issue debt. They all did it, and most of corporate debt in the U.S. is 5 years. So now, these guys all have to roll over the debt in the second half of 2025. If they roll over at much higher rates, that means that CapEx is going to get cuts. That means that employment is going to get cut to pay for the debt. They have to get the cost of debt down. Without that, you're facing a really bad 26. And guess what happens in 26? Midterm elections. So take the pain up front, get the lower interest rates, so that the economy can be rebounding by 26 on the back of lower energy and lower interest rate costs.
Okay, let's just complete the tariff point.
Sure.
So I think average tariffs into the US are 2.5%, 3%, somewhere there.
Yep.
By the end of the year, where do you see those?
That's a really tough question because I think a lot is going to depend on those negotiations with China.
Okay.
And here,
But they're going to be higher. We don't know.
I think they're going to be higher because part of, I think, Trump's view of the world is foreigners should pay more. Now, I'm not quite sure how he came to that conclusion, but essentially, one of his hardcore beliefs is foreigners have been taking advantage of the United States and they need to pay more. And a lot of these policies, like the golden visa thing, where foreigners are going to pay $5 million to move here, even though you already have an EB-5 visa that costs $800,000 that only 2,000 people take a year. Somehow millions are going to take the $5 million option. There is this perception of foreigners have to pay. So yes, there will be higher tariffs. The big question is, will it be marginally higher? So you say 2.5%. Will it be 10? Will it be 12? If that's the case, that can sort of come out in the wash. Like if you got a 10% across the board, that's not going to throw the global or the US economy off the rails. If you move to 25, 30, then all of a sudden, that's much more problematic for global growth.
Okay, let's talk about what is important for emerging markets as well, which is the US dollar. You're saying he wants the dollar lower, and so far it seems to be working.
Yes.
Right? Yields are down, I think, about 50, 60 basis points in the 10-year over the last 1.5 months. Dollar is lower as well, the broader dollar. What's your sense, Louis, here?
Well, look, I think when you look at Treasury Scott Bessent, Treasury Secretary Bessent, his very first thing when he got into his new office was first thing he did was to pick up the phone to call his Japanese counterpart and to essentially tell him, look, the yen is too low, which it is. The yen is ridiculously low. If you spend any time in Japan, it used to be that if you went out for dinner in Japan, you'd have to check your bank balance to make sure you could afford dinner. And now, you go there and, things are really, really cheap. So bottom line is, the U.S. does want a revaluation of Japan, does want a revaluation of the won, the Korean won, does want a revaluation of the renminbi. That's going to be, obviously on the table with the discussion with Xi Jinping in May. I think there's a good chance that that gets achieved because all these currencies are today massively, massively undervalued. The U.S. dollar is very expensive. You go travel in the U.S. today. For most of my life, traveling to the U.S. Was a decent value experience. Today, it's completely out of whack relative to everywhere else in the world. Yes, the U.S. dollar has to come down. It's too high.
But Louis, isn't it quite conflicting that you are you're doing the fiscal consolidation, and there is a possibility of a dollar going down? You're just talking your way through, or you really want to implement? You can really push this through?
Yeah, that's a great point. You're absolutely right to highlight that usually fiscal consolidation, you tend to have a bit of a stronger currency. Now, having said that, in the past 2 years, you had massively pro-cyclical fiscal policy in the United States, and the dollar still went up because, at any one time, I think you have many factors can impact a currency. And in recent years, the biggest factor impacting currency has been interest rate differentials because the U.S. yields were going up, U.S. dollar was going up. If they're going to be successful in bringing yields down, then partly through Doge, partly through cuts in government spending, maybe a little less issuance of treasuries than the market had expected, maybe arm twisting China, Japan to buy more bonds, a little bit of this, a little bit of that, get yields a bit lower. I think the U.S. dollar does roll over from the current level of overvaluation. I think it's happening, actually. It's already starting.
And I think it'll be good news for capital flows into emerging markets if that were to happen as well. Of course, the other stuff will play out as well. The other thing is the market here in India has been weak. I think the market here in India and the US have been very, very tightly correlated. Two best performing large markets in the world last few years. But here we've started to pull back. US, the S&P is just under 5% away from its all-time highs. Do you think we're starting a correction in the US as well, especially large cap tech, which actually is the only space which has mattered, which has driven the US outperformance, is the top in there? Your thoughts?
Yes. No, I think we've just had a massively important event with DeepSeek. DeepSeek changes the world we live in. It changes it on many different fronts. First, until DeepSeek came around, the perception was that the US could contain China technologically. The fact that China all of a sudden shows that it's at the same level on artificial intelligence as the US shattered this illusion. The second reason it mattered is that up until 10 minutes ago, the widespread belief was that all these huge Mag 7, these big cap tech stocks, could in essence build monopolies for themselves through unprecedented capital spending. That if you wanted to play at the AI table, you needed to put 50 billion a quarter on the table as your ante. DeepSeek has also shattered this belief. And so all of a sudden, the idea that you can spend your way into building a monopoly for yourself, into building ever bigger moats, has been completely undermined. And I think with that, you have started to see a rotation in the market where indeed investors start to say, well, hold on, if Microsoft, Google, Amazon, if they're not going to be the massive monopolies I thought they were, do I still want to pay 35 times earnings, 40 times earnings? Especially if at the same time, you're starting to get other stories around the world. Now, you pointed out in recent years, there's been only a handful of stories. There were really three. It was gold, US tech, Indian equities. That was it. Like anything else you did was kind of lame. But now what you've seen is while the US starts to fiscally tighten with Doge, China is fiscally easing and starting to do a lot of pro-consumption measures. Europe is fiscally easing. And so as the fiscal easing shifts from the US to China and Europe, lo and behold, China and Europe start to outperform. All of a sudden, there's other things to do in the market. Maybe I don't need to just own Microsoft at 35 times earnings. There's other exciting things to do.
There's some very interesting graphics, as you were talking as well, from your research, which you're putting out for our viewers. We will continue this conversation, Louis, and I want to sort of connect that with flows as well, right? I mean, there's always this debate whether when money goes into China, we get our money through EM funds.
Yes.
So if China gets money, we get money, or is it, I mean, one at the expense of the other? We'll sort of ask you that. Let's just take a quick commercial break here. We're going to come back, continue this very interesting chat with Louis.